Coach here with the Van City Home live, and clearly not from home. Excuse any distractions that we have in the background. How's everybody doing? Today we're going to talk about mortgages. I'm not a mortgage broker, but I do have a little bit of background knowledge on mortgages, so we're going to answer some questions that maybe those of you who are thinking about buying a house or who are changing your mortgage terms might want to know about mortgages that you maybe didn't know before. Hi, Corinne, how are you? Thanks for joining. Okay, so let's talk about how mortgages work in Canada. So I know some of you viewers are from the US, so mortgages are handled a little bit differently in the US. But not everybody has, well, mortgages in general. First of all, what is a mortgage? A mortgage is the ability to buy a house that you maybe would not necessarily have the full amount of money to buy. So you have to take a loan in order to make such a large purchase. Especially where we are in Vancouver, the house prices are pretty high, so there isn't too many people that would be able to afford to buy it outright. So there are some different types of mortgages, so we're going to go through that in a minute, and there's different rules that go with each. So number one, you need to have a down payment. So there used to be some mortgage programs that had 0% down payment. They don't really exist, and they really didn't before either. They actually have an option for you to roll your down payment into your mortgage payments. So it just seemed like they were gifting you the down payment, but in fact they weren't. So in Canada, you can only purchase a home if you have enough money to cover your down payment. So the down payment percentages vary. So they are generally 20%, but a lot of people that have, great credit have been able to buy properties with 5 and 10% down. Corinne, it looks like it's you and me. Oh, here's Nicola. Hi, Nicola. So 20% though is the norm. A lot of people have been breaking into the market and buying with 5% down, which is a lot more affordable, especially if you're buying $1 million property or less, which is pretty normal in the Vancouver market. So the second thing you have to do is you have to get pre-approved before you can actually even apply for the mortgage. So during the pre-approval process, they will check your credit rating, and they will check your what's called a beacon score. So a beacon score is a rating that the conventional banks use, well actually everybody uses, in order to decide how much risk you are to them. And basically that's what it's all about, risk management. So a few things that the lenders would want is, your proof of identity, proof of address, employment information, proof of income, debts, assets. So if you're thinking about buying a house, hi Crystal, and hey, if you're thinking about buying a house, don't go buy a car, because a car payment will drastically affect your score to qualify for a house. And a lot of people don't know that. It seems really appealing, and you think, oh, I'd like to have a new house and a new car. Well, my advice would be buy the house first. You're more likely to get pre-approved for the car later, not the reverse. Number 3, you must determine what type of mortgage you want to get into. So there's mainly 2 types. There's an open mortgage or a closed mortgage. So you have to really determine what suits you best. So with an open mortgage, there's more flexibility. You can pay more off in a much more rapid time. So let's say you're buying a fixer-upper and you plan to sell it pretty quick. You probably want to get into an open mortgage. If you're planning on staying long-term and you can't really afford to make the extra payments and you just want to ride out the term and the amortization, which I'll tell you what that is in a minute, then you're probably best to go with a closed mortgage. And closed mortgages tend to be a little bit better interest rate than open mortgages. And again, there's a lot of work, I guess, for the lenders, so they want to make sure that they secure their investment as well. Okay, so now we're on to number 4. How long will it take you to actually pay off a mortgage? A lot of people are confused between amortization and term. So the amortization time is generally between 10 and 25 years, is actually the time that it would take for your mortgage. However, lenders generally lend you the money based on short term. So you can get a 2-year term, 3-year term, 5-year term, and sometimes 10-year term. So those terms basically guarantee that particular interest rate if you go for a fixed rate mortgage during that term. And then when you go to refinance at the end of the term, the interest rates may have gone up or they may have gone down. So that's why they break it up into terms. Some other countries actually have the same interest rate for the duration of the amortization period. So you will never have a fluctuation in your interest rate, but in Canada, we have terms for mortgages. So number five, you'll need to, we kind of brushed upon it already. You need to renew your mortgage once the contract expires. So each term, you're going to renegotiate it. And you could then at that time secure a lower interest rate. You could also secure a higher interest rate. So you have to be careful of that so you don't over yourself beyond your ability to pay. Have a tendency to give you a range of your affordability. You probably want to stick to mid lower end of that range. Should the interest rate fluctuate, you don't want to be caught having to make double the mortgage payments. Number 6, you want to choose between fixed interest rate mortgage or a variable rate mortgage. So the difference between the two is a fixed rate mortgage is a fixed rate. You pay the same rate all the way through the term of the mortgage, and a variable rate it fluctuates based on prime rate. So you have different payments all the time, and they tend to be cheaper unless of course the interest rates. And then of course you're going to be paying according to those interest rates. So if you like to have a fixed payment, kind of like being on an equal billing plan, then I would go with a fixed rate mortgage. Number 7, how frequent will you make your mortgage payments? So you can actually choose in Canada how often you make your payments. So you can make them monthly, weekly, bi-weekly. And so if you take a look at online, there's a lot of different payment schedules which will show you the benefit of paying them off quicker because you'd have a tendency then to pay, you pay extra payments throughout or extra payments in the year will allow you to your mortgage faster and without you really noticing the difference too much in the payment. 8, versus high ratio. So you heard conventional mortgages are a little bit harder to come by these days. They require 20% down or less if lucky, up to 20% down. Have to be insured by CMHC, which is the housing, and you have to qualify at the contractual rate plus 2%. So they have what's called stress test now, and that's all conventional mortgages. So some of the lenders are, the banks, TBC, those are all conventional. So people are now whether or not conventional lending is for them because it's a little bit harder to qualify for. So there are some alternatives, and I'm going to talk a little bit about the different tiers and which lenders there are available. So last but not least, 9, understand lender tier options. So institutional lenders like IBC, RBC, BMO, TD, Scotiabank, those are all, I've heard the term A lenders. They're the most stress attached. They're the ones that you have to go through the stress test. You have pretty stringent qualifying criteria. And then second to that, you have what's called a B lender, which is just below the A rating. Still a bank, may have a little less stringent qualifying criteria. But a lot of people are now trying private lenders because there are some pretty competitive rates out there for private lending. The barriers are a little bit easier for qualifying. So if you lack in your credit history, where maybe a B lender may not even qualify you, or an A lender for sure not, then maybe a lender might be an option, even if it's for a short term. And then a year from now, when you're in a better position and you've shown your integrity of paying your mortgage, then you can roll it into a conventional mortgage. So, hey Jesse, thanks for joining. Hi Harris. I hope I pronounced your name right, Harus. Anyway, I hope you enjoyed this week's live. I'm going to see you again on Thursday at 6 o'clock. I cannot remember at the moment what the topic is, but I'm sure I will get up to speed before Thursday. And I hope that I see you all again on Thursday. See you.